Good evening, everyone. I am going to start the session now. Hi, everyone. Thank you for joining me today, and a huge thank you to CFA Emirates Society for bringing us together today to discuss something very, very important. This is personal portfolio management. You guys are on your way to become charter holders. You will be responsible for a huge amount of money later on. But during the journey, it's so important to understand the importance of markets, and the only way to understand the market is to interact with it yourself. So before you start making money for others, it's important to make money for yourself. And that is why we are here today. By way of introduction, my name is Fareeha Hussain. I am a CFA charter holder. I'm a certified treasury professional as well. I did my MBA back in 1995, which was exactly 30 years ago. So as you can see, I've spent last 30 years of my life in understanding the corporate ups and downs. Stock market drives me. I just absolutely love the ebb and flow of it. I love everything about it. When I'm making money, when I'm losing money, no matter what is happening, it is always so, so exciting. I am here today to pass on some of that spark and excitement to all of you. And in case if you haven't made your portfolio, my objective today is very simple. It's going to be a completely non-academic kind of day. I will not be talking about the betas and the volatilities. I'm going to talk about the real world stuff. And more than market timing, it's the time you spend in the market which is important. So that's how we are going to proceed today. There will be three segments of today. In the first segment, I'm going to walk you through certain fundamentals, how the landscape is changing. Second is about you. You will be looking at your personal risk appetite. So there's going to be a quiz, and you will be finding out who you really are. And in the third segment, and I'm sure you'll find that very, very interesting, that's the action plan. If you're here in UAE, how are you going to invest? So we keep talking about stocks, bond, Bitcoin, gold, but how do you invest in that? How much money do you need for it? What are the platforms? So, and what is an exact action plan that's going to make sure that your life changes from today, inshallah. Let's get started. Bismillahirrahmanirrahim. So this is personal portfolio management, doing it the right way with me. Let me change the screen. All right. Now, imagine the year is 2010 and you're holding $10 in your hand, and your friends are coming over and you're like, okay, let's order some pizza. Now, instead of having that pizza, if you had opted to purchase Bitcoin with it, how many Bitcoins would you have? Quick math, guys, come on. So in 2010, one Bitcoin was for $0.05. That means that you could have purchased 200 BTC. You know how much that is worth today? Let me show you. If you had not ordered that pizza and if you had opted to purchase Bitcoin with it, and some of you might be thinking, oh, I was 3 years old back then. So you would have $21.6 million right now. This is the beauty of investments, that when you spend time in it, this is where it takes you. So the earlier and more intentionally you allocate money, doesn't matter to which thing, like whether it is gold, whether it is stocks, it's Bitcoin, whatever you invest in over time due to compounding, you will see that the results are going to be amazing. And if you're thinking, oh my God, that's like a 15-year holding period, how about a couple of years? So I have another example for you. Let's go back to 4th November 2022, which was like literally 3 years ago. If you had purchased the Meta stock, which is your Facebook, Instagram, WhatsApp, at $90, each stock is worth how much today? 751. So for those of you who have financial calculator in their hand or nearby, you can try computing the holding period return on this one. So put $90 with the minus sign as present value, 751 future value, 3 as N, CPTIY, and you'll be amazed to see that it's 102%. Your money, if you had invested on 4th of November in a very regular stock, like, it's a safe stock. Facebook is considered safe. This is a blue chip, part of S&P 500. If you had invested in it, so we are not talking about taking some crazy risk in a company that you don't know about. We are talking about one of the most well-known firms in the world. Even in that, imagine the kind of money that can be made. And that is the purpose of today's webinar. The purpose of today's webinar is to showcase that we are not talking about things that are extremely risky or, very few analysts are following that, not much information is available. No, we are talking about a stock which is right out there. And even in that, there was so much opportunity. And if you had purchased the stock during its IPO, which was at $38, you would have made 25% annual compounded growth. And that's a lot. Can you think of any other investment where you can put your money and it grows by 25%? And this is not a risky stock. This is like within the asset class of stocks, Facebook or Meta is not risky because it's a blue chip, right? So building wealth is a behavioral game disguised as a mathematical one. That's why I made you solve the IY on the calculator just now. And the most powerful variable is the time horizon. Give it enough time and you will become a billionaire before you know it. As future charter holders, it's your mindset that I'm interested in because I am extremely confident of your skill set. I am very confident of your book knowledge, but it's a shift in the mindset that has to happen, and that's what we are going to achieve today. So you know your asset classes, you know how assets behave together. Like we are more interested in their correlations than whatever they do on a standalone basis. And most of your portfolio's volatility can be explained by which asset classes have you invested in. So the core asset classes, so for my CFA candidates who are watching it right now, I'm just going to break it down a little bit because there might be some people who would be watching the webinar who are not core from the CFA background. So just to make things simple for them, we have some basic asset classes. An asset class is just a category or type of investment that you make. So the first one we have is equity. Equity means stocks. We call it shares, we call it equity, we call it securities. These are all interchangeably used terms. So when you invest in the stock of a company, you are literally sharing the profit and loss of the firm. So if the company is making money, it will be passed on to you either through dividends or the price appreciation of a stock. If the company is losing money, the stock price will go down. Worst case scenario, company goes bankrupt, so you lose all your money. So equity among the asset classes, the traditional ones, is considered risky because there is no downside protection. You can literally lose all your money. And that is like the maximum loss will be the amount invested. You're exposed to market volatility. Example is a common stock that you can purchase or an ETF, exchange traded fund. So again, this is not for my CFAs. This is for like regular people. What is an ETF? ETF is like, you go to a supermarket, either you can purchase fruits yourself, or if you're only interested in citrus, maybe Waitrose or some other, like wherever you go, they have already made a pack of all types of citrus fruits in it, or all types of berries. So you don't have to pick all the berries yourself. Somebody has already done that. So that's an ETF. You can take exposure to a particular asset class, asset sector rather, like IT or something, pharma, if you're interested in that. The next one that we have, the category is fixed income. Now, if the sound of you losing all the money you have invested and not knowing where things are going is not something that you like, consider investing in bonds. That's what we call the fixed income, predictable cash flow. But if market rates change, then you may feel really good or really bad. For example, you have invested in a bond that's paying 5%. 6 months later, market rates go to like they go up by 2%. You will not be feeling too good about your bond. But you will feel great if the Fed cuts the rate, and that is what has happened yesterday. We'll discuss that later on as well. You're extremely risk averse. You don't want to take risk. Then instead of keeping your money in a bank account, consider putting it in a money market fund. Money market fund, at least they give you exposure to treasuries. It will earn something for you, which is better than the money lying in the bank, and it's just as liquid. Lastly, my personal favorite, that there you have it, the Bitcoin. I've been advocating the Bitcoin since 2017, I think, aggressively. Like, whenever I have a word with my audience, I usually mention Bitcoin. And now it is part of the mainstream. It's like, it's wonderful to see it evolve and become what it has become. Alternative and digital assets, they provide you with diversification. They are illiquid and valuation risk is there because you don't really know what this thing is actually worth. So private equity, hedge funds, real estate investment trusts, and commodities, these are where you can invest. Now, if you want to take a picture of this, because the way I made this slide was educational reasons. Second, these are, in my opinion, good buys. So if you want to take exposure to any of these asset classes, what is written here is probably a pretty good thing to do. And for example, something like Blackstone REIT, for which you cannot take a direct exposure because these funds are usually for accredited investors, which are high net worth. What you can do is you can take an indirect exposure through their stock. That can also give you good return. So what's the role of asset classes? What's the last turbulence that you can remember? When was the market in trouble? So you may be thinking suddenly of the dot-com bubble. You could be thinking of 2002, Enron collapsing. You could be thinking of 2007-8 credit crisis. You could be thinking of 2020 COVID. But let's come to 2025, April 2025. That was when tariffs were announced. That was when market really plunged. And it plunged by 6 to 8% in 1 week. Now I'm going to show you the benefit of spreading your risk across different asset classes. If you were 100% invested in equities, like something like an S&P or Nasdaq, which is an index, your portfolio would have lost 7%. 60% stocks, 30% bonds, 10% alternative, the drop in the value is down by 3.5. And if you were holding cash, that will be even safer. And this brings it to minus 2.3. So the same market turbulence has affected different asset classes differently. And that's what we are trying to emphasize over here. As we progress through today and you start thinking of what are the asset classes you're interested in, you will keep this thing in mind that markets are not always going to stay smooth. They will not always be rising. There will be ebb and flow. So how are you going to protect yourself? The asset class choice is going to help you. So I'm going to help you in making your own asset allocation and how things have recently changed and how we are deviating from the traditional portfolios. That's what we are going to discuss. The evolving landscape of your asset allocation. If you invest in a traditional 60-40, which is a stock bond portfolio, it'll underperform because it won't be able to beat the inflation and it's not going to give you sizable returns. So institutional investors are moving towards alternative markets. And globally, pension funds, they have started investing more in alts. Your private credit has gone up. Infrastructure and renewables, these are also very popular. So people are no longer just chasing the yields. They are coming up with different ways of diversification. Whatever you and I know about gold having negative beta, all of that has changed. So we need to be aware of that so that we can capitalize on it. From passive beta to private alpha. Allocation is becoming smarter, not broader. So if you look at the rise of alts, it has gone up by, from exceed to 23 trillion asset under management by 2027. This is what's expected. So they are going to really outperform other asset classes. Private credit is on the boom. ESG has been around for the last couple of years, still continues to do so to really engage certain type of investors, and this is mostly for the European community and the institutions over there because their regulations are very, very strong. Inflation hedging and AI driven. Now, again, what I want you to do is to take a picture of this slide, because whatever I have listed as examples and vehicles, these are my recommendations. So these are out of each of these categories. The best ones are listed here. And at the end of the session in the chat, I'm also going to put all the links so that if you want to do a deep dive and do your due diligence, you can go over there and you can, get more info. So the big events you must watch out for that can shake your entire portfolio. Number one is your interest rate cut, which has happened yesterday as well. I'm sure most of you are aware of it. So what's happening? What's happening to the US economy? And how does it affect you? So the thing is that the US economy has a spillover effect on the rest of the world. Uh, Dollar, as we know of it, has weakened against a basket of currency. So what we say is weak dollar. When dollar is weak, it's going to have certain impacts. And people will run to something else as a store of value. And that is your gold and Bitcoin, by the way. Interest rates going down is primarily because, where theoretically, when interest rates go down, you can borrow cheap money and your corporates are going to expand. People are going to start businesses. It's going to move the economy from recession to boom. And at the moment, the US economy, you must be aware of the term stagflation. Stagflation is when your unemployment is high, but your inflation is high as well. So if you have an expansionary monetary policy by decreasing or cutting the rates, and on the other side, so cheap money is available so that people, set up businesses and start becoming employed. Instead of that, people go start spending more in the market, which just pushes the prices of things up, and that is inflation. So stagflation is actually something that they're trying to combat. The trade tariff war, before your session today, I was just reading about the US and China development, like as things are developing. Trump is meeting the Chinese president, and let's see how things fare out on that one. And whenever your inflation is high, you are going to try and stay away from bonds because the real return over the years is not going to be what you expected. So where are you going to put that money? You will put that money in equities, gold, and crypto. So they become more attractive for an investor. What's the key takeaway from this slide? When interest rates are going down and inflation is likely to be high, you do not invest in bonds. Where do you put your money? You borrow cheap money and you put it in a good store of value, such as gold. Or you find yourself good equities that can beat that inflation and you put it over there. Now is the time for your quiz. So I hope you have your pens ready. What kind of investor are you? Let me see if I can open the chat on the side, and let's just, okay, because I'd really like to know what kind of an investor you are. I'll admit them. Okay, so here is your first question. I hope you have your pens and papers ready. So time horizon, how long before you expect to withdraw a significant portion of your investment? A, less than 3 years, B, 3 to 7, or C, 8+ years? Take your time, think about it, and just jot it down. Okay, next question. Reaction to market volatility. You find that you invested $100, 85 is gone. sorry, 15 is gone. Now you're left with just 15, 85% of it. It was a drop down of 15% in a month. What are you going to do? Number one, sell to prevent further losses. So you bought something at 100. Will you be willing to sell it at 85? Or you're going to wait and see if the market is going to recover. Or if you're like me, you're going to think of it as a buying opportunity and buy more at 85. So you bought something for 100 and now it is at 85. So what you do is you buy another stock at 85. So now your average will be kind of in the middle, right? So the moment the stock price is above $93, you'll start making money because now your combined value is 185. Usually when there's a dip, we say buy the dip. When the market goes down, it's an excellent time to purchase. Question number 3, investment objective. Why would you like to invest? To preserve the capital, you got sizable inheritance and you're like, okay, my grandfather left me this, I want to keep it. I'm not losing it. Second, you want to grow it moderately while managing the risks. And C, you want to maximize your long-term growth. You're like, I'm 25 right now. I'd like to retire at 40, buy a yacht, just go around, see what's there in the world. Number 4, how familiar are you with stocks, bonds, and alts? Because this webinar was meant for CFA candidates, I would like to believe that you are very, very familiar with all of these classes. A, minimal experience. B, moderate. I've invested before. And C, advanced. I actively manage or analyze portfolios. So you think about it and then you answer this. Last question, risk and return preference. Are you okay with a 3% risk, or you want something like 6%, or I want 10%? What kind of return would you like to have? Now you're going to look at your answers and then let me know in the chat. Push this on the side. Let me know in the chat what kind of investor are you? If you are, let's see if I can move it to this side. Okay. Mostly A's, you will be conservative, prioritizing safety. Mostly B, you're balanced. And mostly C, your growth. So can I have your answers in the chat? Let's see. Okay. Mostly C. Wow. Yeah, I can see most of you are risk seekers. I haven't seen an A yet. Yes, Omar, that we have very expensive pizza, I agree. You would probably not stay friends with those people for whom you ordered the pizza. All right. So I have at least one A. I like that. Oh, no. I like that, my dear. So I have at least one person who is risk averse. I started out as a risk averse investor, but then over time, I think I realized that you don't really lose money in the stock market. And I think that would be a very questionable sentence coming from a CFA charter holder. But to be honest, I've never seen anyone lose money in the stock market given enough time. Given enough time, you don't lose money. All right. Not a very popular opinion. Please don't answer that in a CFA question, okay? This is just real world stuff. High risk aversion. You want to protect your money. You do not like losses and you'd just like to keep it safe. But then please ask yourself, how old are you right now? Okay, so if you have a long time horizon, my suggestion is always that invest a little, but do invest in something that's going to grow a lot. Just because you have, for example, if you have very little money and you are 25, 26 years of age, or let's say up to 30, bonds are not the place where you should be investing, right? You should be investing in stocks. Don't put all your money, put like 5% of your money, but put it in the right place. So be careful with that. Now, this is your asset allocation, which I would advise to anyone who is risk averse. And much to surprise of many of you, I have put equities there. Even if you're risk averse, it's a good idea to put 20 to 30% of your money in stocks, but put it in something which is very safe, which is the top of your S&P 500, or in dividend aristocrats, which are going to be your Pfizer, this is Chevron, like good companies that pay very handsome dividends. You can invest in them. Alternatives as well. This is your core real estate infrastructure debt, and you can keep your money invested in money market funds. I'm going to stop over here and say something very important. Just because you are a risk averse investor, because maybe your job is not very safe, maybe because by temperament you are like this, even then, it's advisable that instead of leaving your money in a bank account, you at least put your money in a money market fund. It will give you a return higher than what that money lying in the bank is doing for you. So if there is one shift that I'd like from you after today's session is, which your bankers are not going to like, is to at least move the money which is lying dormant in a bank account, move it to a money market fund, which is very safe. Your neutral or risk balanced investor, this person is benchmark investor, so they'll put their money in S&P 500, and we will be seeing how this turns out. So as I progress you towards your practical portfolio, you will see how even investing in S&P would have given you an amazing return over 5 years. These such investors don't get emotionally attached. I am not this investor. I'm very animated. I love the stocks that I'm fond of. I hate the ones which I don't understand and do not wish to buy. I'm an emotional trader personally. These people combine income and growth, and this is my recommendation for you. If you're risk neutral, put your money 60% in S&P 500 and then 20 to 30% in really good investment grade bonds. So don't put your money in treasuries. Put it in investment grade bonds. Again, you got your alts classes there. You can shift REITs to Bitcoin anytime or gold. Now, low risk aversion, the opportunistic guy, I saw lots of C's in the chat. So this is for all of you. Whenever market is volatile, that's buying time. So, recently I started feeling like a vulture because I was literally waiting for the market to collapse, which is not a very nice thing to say, but honestly, once you get used to the market turbulence, and for me, I'm someone who has been investing for a long time. The moment the market shows sign of panic, that is when I say, okay, great. Whatever I've saved in the last 6 months, this is the time to put it in. I do market timing also, but in the long run, we all make money. So market timing is amazing because it is very exciting. It feels really good to make money overnight. Like I remember when Trump was about to win but had not won yet. So I put a lot of money in Tesla, and next morning I was rewarded for it. So these are this is low risk aversion. The opportunistic investor sees threat as an opportunity. A threat to majority. This person sees it as an opportunity, and this is the contrarian view. But over here, again, if you notice, the way I have created the portfolio for you, and I hope you guys have been taking screenshots of it. And by the way, this is a recorded session and it will be uploaded on YouTube later on. So in case if you want to revisit some portion of it, you'll be able to do that. Now, notice in equities, even if this is an opportunistic investor, I'm not suggesting anything crazy. So like I'm saying that you do smart investment, you're not going to lose money in the market. Although market is open to downside as well, like we have this disclaimer, this is educational, this is not a professional advice. But at the same time, you do smart investments. You want to put money in stocks, go put money in Apple, Nvidia. For your fixed income, you can invest in bonds. For alts, there's gold, there's Bitcoin, and cash. This person will keep it to the minimal. So that was about your portfolio. Later on, like after 5 minutes, I'm going to start giving you actionable stuff, which is how you're going to actually do all of this in UAE's market. But at the moment, I really want to discuss a few things that have happened in the market recently, and one of them is the gold anomaly. Now, the purpose is that after attending today's webinar, if you go out there and you are discussing something with someone, you are going to make meaningful contribution to that conversation. So what has happened to gold, stocks, and Bitcoin recently? How can all of them be at an all-time high? You know that gold is supposed to be your safe haven. So as stocks are, when stocks are going down or market is going down, that is when your gold usually goes up. But at the moment, like what we have seen recently is your stocks are rising and the gold is rising as well. And on the side, Bitcoin is rising as well. Why is it happening? What is the key driver? Actually, the drivers are different. I will tell you. So because of low interest rate expectation, money is flowing into stocks. So why are stocks rising? They are rising primarily because of the cut in the interest rates. When there is more liquidity, it pushes the prices of all the risky assets up. They all go up together. There's fear of inflation, and people know that bonds cannot beat that. So where do they put their money? They put their money in stocks and in real assets like gold. Central bank started buying gold. This was the reason why gold went up. So let's mentally segregate this. Stocks are rising because interest rates went down. Gold is rising because dollar is getting weak. And when dollar becomes weak, people run to, safety. So that running to safety is gold. They are not running to safety from stocks. They are actually running to safety from weak dollar. And central bank started buying gold. And Bitcoin is now seen as the digital gold. And there are some other reasons which are behind Bitcoin that will come to in 2-3 minutes. Why should we care about all of this? This is because the diversification language has changed. So in 2026, if you want to make money, you can, like again with disclaimer, it's a volatile market. I cannot say anything for sure, but we have predictions that gold, stocks, and Bitcoin, all three will go up. Gold will provide hedge against your currency debasement for dollar and geopolitical risks. Stocks, they hedge against inflation through your corporate profits. How does that happen? Because when the prices of your commodities are going up, most of the time the corporates are able to pass that on to the customer. So it becomes part of their profit. And therefore, when you buy the stock of a firm, you kind of, you're benefiting from the inflation. Bitcoin, hedge against monetary debasement through digital scarcity. Central bank is buying gold. Retail investors are buying crypto. Both are reacting to the same fear. And what is this? Money losing value in real terms in future. And that there we are talking about dollars. Old rules are changing. Most of the, like what I have witnessed is that it's either fear or greed. But this is the first time I'm seeing a market that's displaying both greed and fear, both at an all-time high. Institutional investors' view on this anomaly that that gold and stocks are both rising at the same time, because gold is being viewed as store of value, not just a hedge for currency, and the central banks are buying. Morgan Stanley, this was BlackRock's opinion. Morgan Stanley, according to them, it's a structural shift. So things are changing and we need to be aware of that. And Vanguard also. All of these details, you will find them in links, which I will share at the end of this presentation. What it means for us as investors is gold's correlation with equities has increased, which was historically negative. Now it has increased. So short term, it will not hedge for stocks. Long run, we are not sure about because they normally just started. And now gold has become part of the growth tribe. Before it used to be part of the safe tribe. Now it's part of the growth tribe. So for your portfolio, gold, stock, crypto, each one of them is hedging against different risks. So this is currency risk, policy risk, and rate cuts. So they are protecting you from this. This is a non-traditional correlation now. And now from gold, we are moving on to Bitcoin. Is Bitcoin going to collapse? Warren Buffett, 2018, he said Bitcoin is rat's poison doubled. Squared, sorry. And then later on, he was like, if you give me all the Bitcoin in the world and tell me to purchase it for $25, I'll still not buy it. So has been historically against Bitcoin because it does not have an intrinsic value, and therefore he does not find it a productive asset. Vanguard Group, they said they'll not support spot Bitcoin ETFs, citing it's speculative and it's very volatile. So this is this is what certain people have been saying. But do I agree with that? No. Is Bitcoin here to stay? Very personal opinion, I think it is here to stay. According to BlackRock, they now hold a very large Bitcoin position and 3% of the total supply. And then you have the institutional legitimacy is growing. Again, I'd like you to stop over here and think about this. So the US government, their pension funds are one of the biggest institutional investors in the world. And the Trump admin, they have allowed Bitcoin as one of the asset classes under ERISA, under Department of Labor, that they can invest, the pension assets can be invested in Bitcoin. Now, a little bit of upside came when this news came out, but a bigger upside will come when these pension funds, they actually start purchasing Bitcoin and allocating money to it. As you guys are aware, that institutional investors take time, they have procedures to update the mandates and everything, the investment policy statements. So once that thing starts rolling out, you will see Bitcoin going up again. And the regulations are increasing, or the way you invest in Bitcoin is changing. Bitcoin ETFs are approved. For supporters, Bitcoin's role may be evolving from speculative to a reserve or hedge asset, reducing the collapse risk if the broad adoption continues. So we have seen Bitcoin to stay sturdy, like it didn't collapse as much as it used to in the recent times. So you can have a personal opinion about it. I have been long on Bitcoin since it's 4,000 days. When it used to be 4,000, then we purchased some when it was 7,000. I think at 13, I bought again. Then at 18, because it used to be, that's when resistance used to come, didn't go higher than that. Then I explicitly recall when it went up to 60K for the first time. And so after that, I think I haven't sold my Bitcoin. So start at home. These are some of the platforms. Take a picture of this. These are places where you can start investing. I am going to talk about Serva Invest. This is your UAE robo-advisor, low fees, automated ETF portfolios, Sharia options. You can check those. The local landscape in UAE is very conducive to investing. It's digitalized. Everything happens in your palm. You can invest in Sharia compliant investments if that's something that you'd like to do. The impact of the Fed cut and the outlook for 2026. So the stocks and equities may still experience an 8 to 12% upside. Gold is likely to hit 5,000 next October. So there's still approximately 1,000 that can still be earned on this, which given the price may be something like a 20% return for you. and Bitcoin from 20% to 60%. As you can see that the confidence interval is very wide. Like, for the more something is volatile, the more your confidence intervals will be wide. So 20 to 60% upside is still expected out of your Bitcoin in the next year. Throughout my presentation, you may have noticed that I have focused on these three things: stocks, gold, and Bitcoin. You invest in them wisely. And so this is what I just talked about. Now we are going to talk about the steps that you're going to take. So I still have 15 minutes. I will finish in 5 minutes and then we will have time for your questions. Now, what's the first thing that I want you to do? The first thing I want you to do is to decide your time horizon. Before you start investing, you need to set aside 3 months worth of living expenses in cash or money market funds. This will protect you from selling your stocks in case if market is going down. It's going to protect you. So because if you have 3 months worth of savings, then you can play it safe. Start with a practice portfolio on Excel, which I'm going to show you right now. Observe the stocks, gold, Bitcoin across different market conditions. So before you put money into it, put thought into it. And begin when you're ready to start, go for a mutual fund first. The good part about the mutual fund industry is that you give them a call and their advisor will come to your place and he will move heaven and earth to convince you. So you as CFA candidates, most of you can really have that conversation with him, understand him or her. You can understand what the mutual fund is about. Don't rush into complexity. Wealth is built not by timing the market, but by the time in the market. What do I mean by this? Let me take you back. Oh, that went down fast. Let me max it out. Now, it doesn't matter. Most of the time, we're like, I want to do market timing. I want to buy when the market is selling and sell when the market is buying. But you see, over a period of time, it doesn't matter. The important thing was maybe to just buy Bitcoin in 2017, not at a particular price, because whatever that year's price was still a lot lower than what it is today. So what we are thinking in 2025, 5 years down the lane, it won't matter whether you bought the Facebook stock at 663 or at 750, it won't matter. Because when the price has moved to 2000, this little, $50-$60, it's not going to matter a lot. It matters for the day traders. For today, my plan was to share with you all the tips and tricks, not for the day trader. This is long-term investment. And how are you going to do it? This is what I mean by a paper portfolio. So kindly take a picture of this as well. What you have over here is the top of your S&P 500. These are not regular stocks. These are very safe stocks. Now, this is just for demonstration purposes because there have been splits and all. So this is just like very, very basic educational purposes. In March 2020, during COVID, if you had purchased these stocks and if you had $100, this is how you have invested it. And you have invested in Bitcoin, you bought fractionally, you bought gold as well. How much would your portfolio be worth today after roughly 5 years? You would have earned 379% on this in 5 years. So if you want an annualized return, you can see that as well. Now, am I taking any risk in this portfolio? Does it look risky to you? To be honest, it was never risky because these companies are the giants. And unless there is something which is, kind of like a massive, massive problem with, and if there's a problem that big, trust me, none of us would be wondering about a portfolio. Like if that 3i Atlas comes and hits, God forbid. So, short of anything which is astronomical in nature, these are very solid, safe stocks. Now, nobody is ever telling you to put 100% money in Bitcoin. My ask is, keep it 10% or less, but do invest. When you invest and the prices are moving up, it feels great. And then, of course, gold. You can change these. So, what I've done over here is if you click this, it takes you directly to Apple's page today, 271. This is where the stock is. So, uh, this is my ask. What you're going to do is you're going to create your paper portfolio first. So the first thing is decide what kind of investor are you. Tell yourself, okay, I'm going to make this portfolio, and for the next 5 years, I'm going to stay invested. No matter what happens, I'm going to stay invested in this. Pull out only that money which is a surplus on top of your next 3 months' needs and any other major requirements that you have. Whether you invest 2000 dirhams or 5000 dirhams or 20,000 dirhams doesn't matter. Just start with something. Make this portfolio on paper first. You can put today's prices. You can put the links there so that it's easy for you. You can put today's prices and then keep adding a new row. For example, over here is 31st October 2025. You click on each of those links and then you keep updating it, 271 and all. So you can have holding period returns on the side. What's going to happen this way is that you will be able to see how the stock has done over time. So wait for at least 1 month. Make your paper portfolio and wait for 1 month before you actually start putting your money there. And once you are aware of how the stocks are moving, why am I suggesting this? Because when you make the paper portfolio, you will automatically be, so or even if your own money is not invested, but if you come across any piece of news about that stock, suddenly you'll be like, oh, so the stock was 270 yesterday. Why has it gone to 225, or why has it gone to 300? It creates a relationship between you and the stock market without exposing any money, right? So please do this and look at the movement, look at how the Bitcoin is moving, develop a relationship with stocks, with Bitcoin, with gold on paper first in an Excel sheet, and then later on you go and purchase it. There are several platforms, like I mentioned earlier on. You could, you know, you could invest in DFM, get your national investor number, or ADX. You can use interactive brokers. You could use Serva. You could use eToro. For all of them, there are so many tutorials available on YouTube. You can watch any of those on, like, once you decide. So the most important part is this. The main takeaway from today's webinar is this, that after today, you should be able to at least make your portfolio on a piece of paper, which is your Excel sheet. At least make it over there, build it for a month, and then start investing. So this is the end of my presentation. I hope you have enjoyed it. I have enjoyed it a lot because I love talking about the stock market. And trust me, I have more pages which I have followed on Instagram are related to stocks and cryptos. More than I follow my friends, I follow all of these. So thank you so much for today, and let's see if we have any questions. Currency debasement is when your dollar is getting weak, and it gets weak against a basket of currencies, which includes your euro, yen, all of that. Silver over gold, important question. Now, historically, what happens is that you invest in silver when your business cycle is going up. Okay, so at the bottom of the business cycle, that is when silver is at its cheapest. That's when you invest in silver. Because over time, what's going to happen is as market recovers from recession to boom, people are going to place orders for machinery, infrastructure, everything for which silver is needed. So silver is historically purchased at the bottom of recession. That's when it's at the cheapest. And it is sold when you are at the top of the business cycle. That's when you sell silver. At the top of the business cycle, that is when gold is supposed to be at its cheapest, supposed to be, because that's when stocks are doing great. Nobody wants a safe haven, historically, not right now. So you buy gold at the top of the business cycle and you buy silver at the bottom of it. Silver, copper, both have amazing upside expected in the next 1 year, by the way. Ankit, as I was sharing earlier on, as the institutional investor starts stepping in. So right now they are in, if you look at the American pension funds, your 401k plans and all of that, right now they are transitioning towards the Bitcoin. And when all of that big institutional money, when it is parked in Bitcoin, its price is literally going to double. So this is the rationale. Now, because it's still a volatile asset with clearly no basic intrinsic value as we say it. So therefore, like, this is why you see the volatile range to be as wide as 40%. So my rationale is most certainly that I do expect a lot of money flowing into Bitcoin when the institutional investors start buying it. Okay, I'm going to take more questions. Where are we in the business cycle? Now, the challenge at the moment is that the business cycle is being fueled by politics at the moment, instead of being fueled by actual economic data. So ever since Trump has come to the office, there has been, this shuffling is happening. So it's very hard to predict where the business cycle is right now. I would say, because for certain things, it looks like the bubble is about to burst. So for example, for the real estate, they say the bubble is about to burst. So I would say we are approaching the peak at the moment. Safely, I can say that we are approaching a peak. How long should we study a company before we invest real money? Omar, no, you don't study that at all. Okay, just take the top of S&P 500, please. Just take the top of S&P 500. People, there have been people who have well studied it. And once you are following a company, then what happens is that any new piece of news, so for example, for Facebook, their earnings were really good, but the market did not react to it that way. So to be honest, there is no hard and fast rule. So no, just invest in the top of the S&P 500. Targeting next month window, not from financial background, need to do my own homework, get ready for equity analyst position. Anwar, for this, if you can approach me on LinkedIn, I can respond to that. I'll tell you how to prepare for an equity analyst interview. Good. When our investments do go up, when do we finally decide to sell instead of waiting for more highs? That's $1 million question, Adit, because so far I've had a buy and hold kind of a portfolio, because I have, in a very disciplined way, I've been putting money a little bit. You take those decisions when you have some investment goals. So you decide to sell when you have something really important coming up in the next 6 months, something that you had been saving and investing for. When that event is in the next 6 months window, that's when you become alert. That's when you start checking how the market is behaving. For me, one of the clearest indicators are, and here I'm going to, use my financial jargon. I actually look at, the put call ratio. I don't look at the stock market. I actually look at your derivative market when I have to decide to sell something. If I sense or sniff fear, there are going to be more puts. So, or the short positions. So that is the data that I look for. So, Adit, whenever you have next 6 months, in front of you where you need money for a particular goal, that's when you start sniffing for the best time to sell. Other than that, just keep waiting. All right. View on companies that may enter the mega market cap? Not really, not really. And even with Nvidia, we will see how long they're able to maintain that position. Let's see about that. Exposure is recommended for US stocks considering current political scenario. The top of your S&P, the top 9 stocks, just that's what I always recommend. Genuine platform for buying US and UAE equity, that's going to be your Sarva. But if you want to, you can keep two of them. So I personally, Shinaz, I invest through eToro. You know I'm fond of eToro. So I invest in eToro, but I don't have any exposure to the UAE market. And the reason is since my salary is coming from the UAE market, I don't want to increase my exposure to it. So God forbid something happens to the economy, I lose the job and the investments both. So for anyone here, like, that's my way of diversifying. Your way could be very different. And secondly, being a CFA charter holder and having studied, and I teach the US stock market all the time. So you could say I have a home bias for the US stocks. So that's where eToro works beautifully for me. But I hear Interactive Brokers and Sarva are very good. Impact of seasonality. Now, in terms of seasonality, we historically use this term um, for our uh, for our multiple regression where we are seeing a particular trend. So seasonality is I'm saying this for the benefit of others. Seasonality is that's a trend that exhibits itself in a particular time of the year every single time. So the seasonality is exhibited, in 2025 was supposed to be, according to the decennial pattern, it was supposed to be a low year for the stocks. But to be honest, right now, the market is so strange that we cannot make any prediction. So all the trends as we knew of them, that's all changing. It's a very different market. Okay, let me see if there's anything else. Thank you, guys. Thank you so much. It's 8 o'clock. Let's finish this. And please, please do invest. If you need any help from me directly, you can reach out to me on LinkedIn by my own name. So you type Fareeha Hussain CFA, you'll probably find the only Fareeha with the CFA is going to be me. So it's going to be pretty easy. Or you can reach out to the CFA Emirates Society. If you have any questions, they'll probably route it to me as well. And thank you so much. Please invest, okay? Please, you have spent 1 hour in this, capitalize on it. All right, let me see if there's any other question. Thank you, guys. Thank you. Bye-bye. No pizzas over. Next time someone says pizza, say no. Say I'm going to buy Bitcoin. Bye. Take care.